Uh, Good evening, everybody. I believe you can hear me. Okay, so welcome to class today. We start with a new topic. The topic that we're going to be discussing today is one that we talk about the standard IAS1. IAS1. Now, IAS1 basically talking about the preparation of financial statements. It means things that we expect to know, the basic requirements and the basic information that should contain in our financial statements. That's what IAS1 is just trying to address. Now, so the overview of the IAS1 says that presentation of financial statement should be what? Okay, sorry. Presentation of financial statements set out the overall requirements for financial statements, including how they should be structured, the minimal requirement for their content, and the overriding concept, such as the going concern, accrual basis of accounting, and the non-current and current distinction. So basically, this at the end of this program, this standard, you expect to know the minimum requirements of what you should have in your financial statement. You expect to know the content of your financial statement. You expect to know some basic elementary concepts or convention that have to do with preparation of financial statement. So this should be your take home at the end of the day, at the end of the day, so that those are your take home. Okay. Now, other than the being said, let's move to the next question. Let's go to the next step. So the next step talk about the IAS1 was reissued. So we have objective of IAS1. Objective of IAS1 is to prepare the basis of presentation of general purpose financial statement to ensure comparability both with the entities financial statement of previous period and with the financial statement of the other entities. They're talking about the basis of presenting it. What are the things that you expect to have when you present, when we pick up your financial statement? What are the basic things that we have there? And the reason is because we want to compare with other entities. And that is why we call it what we call general purpose financial statement. General purpose financial statement that averagely it can be used by everybody that require or that need such information. That's why we call it general purpose, general, okay? So the scope of IAS is actually what? It applies to all general financial statements that are prepared and presented in accordance with the IFRS. How we work. Also, general purpose financial statements are those intended to serve users who are not in position to require financial reports tailored to their particular information needs. That is also that's general purpose. I've explained that as earlier. It means that those that cannot request, that cannot walk up to the complaint or walk up to the accountant and request for certain information, but they need information to what? They need that information. Those are what do. That's why we prepare general purpose. Example of those. Remember in the class we said we have two type of users, financial users. We have the internal and we have the external. So with the external are some of them cannot walk up to the company directly and request for information. Example, researchers. Researcher can actually what some of the researchers cannot walk up to it except have a high connection. So it's for example a student walking up to it and asking them, okay, why do you get this figure? Okay, where is the revenue? Where is the so if it's not on the face of the financial statement, it might not be easy for them to obtain that information. So then I look at it that what is the minimum requirement that at least averagely, let's say 70 to 80% people what they will need or what they would desire to see on the financial statement. Then they now use that word to prepare to prepare the standard. They're talking about, at every point in time, you expect to have your sales. At every point in time, you expect to have your gross profit. At every point in time, you expect to have your net profits. At every point in time, separate your asset into two. We have the non-current asset and we have the current asset. So that's what they're trying, okay. So they're just trying to present information that to be very useful for everybody, at least virtually everybody, investors, research, government, and so on and so forth. Now, we also say, okay, so we have elements. We have element of financial statement. Now, the element of financial statement, or what comprises of the financial statement, we have the assets, we have the liability, we have the equity, we have the income and expenses, and we have the contribution by and distribution to the owners. That's dividend, capital and dividend. So it means you expect to have a good knowledge about this for very well, so that you're able to treat it. Because every financial transaction that occur in an organization should tailor down to this information that we have here, this list that we have here. We have the assets, we have the liability, we have the equity, we have the income, we have the expenses, we have the contribution by and distribution to owners. Okay, we have talked about them before, so we might not actually will pick up just a reference to it here. Now, we want to understand by component. Now, what if you pick up a financial statement? What are the things that you expect to see in your financial statement? When you pick up a financial statement is actually what is the summary, is the name given to a booklet. It's like a booklet. Okay. Now, if you pick up the booklet, what are the things that you see there? If you pick up a textbook, you see chapters, but that textbook have a name, but you see chapters there. So those chapters are the content of the textbook. Now, this time around, they're talking about financial statements just like a textbook. Then what are the content of a financial statement? What are the reports that you can see in your financial statement? Now, IAS1 listed some mandatory reports, requirements that you must have in your financial statement. Number one is statement of financial position at the end of the what? At the end of the reporting period. Now, statement of financial position, this is a statement that contains your equity, your asset, and your liability information. And if you look at the way it's structured, they said at the end, it means that it's subject to change. So at this moment, this is my asset. But next tomorrow or in 2 weeks' time, my asset, my differs. So that's what it go at the end of the reporting period. Then we have statement of profit or loss and other compressive income, or is also known as well statement of profit or loss with a separate statement of other compressive income. So it means that you have statement of profit or loss accounts and you have other compressive income, or you can have the two together. Okay, you can have the two together, so you can present that. Now, this one is for the year. This one is for the reporting period. It means that it only captures the profits, or it only captures the revenue and the expenses for a particular period of time, and it's not subject to change after that period. So, and that is what we call what? We call the expenses. That way we have the expense and we have the income there. We have our income and our expense under profit or loss account, or profit or loss statement. Also, it's also known as statement of financial performance. Statement of financial performance to know, to test on, or to ascertain the performance of the organization at a particular point in time. Then another content that we have is statement of changes in equity for the period. A statement of changes in equity for the period. Now, a statement of changes in equity for the period is trying to reconcile the opening figure of the equity and the closing figure of the equity. They are trying to reconcile that what is the value of the owners in the business at the beginning of the year? What is the value at the end of the year? Do we have an inflow or we have an outflow? Our inflow, is it a part of contribution from the owners, or our outflow is part of distribution to the owners? They want to arrange them together. They want to try to agree them together. That was called statement of changes in equity for the period. Then we have the statement of cash flow for the period, accounting policy. Okay, that we have that. So stop there. Statement of cash flow for the period. Now, statement of cash flow for the period simply means we want to identify our inflow and our outflow on the basis of activities. So we want to classify inflow and outflow based on activities that the organization engage in. Now, there is a standard for that. That's IAS1 that talk about cash flow statement. Now, this is just trying to identify that the activities of an organization can be classified into three. We can have the operating activities, we have the investing activities, and we have the financing activities. So it means that what it can be classified into three. Now, then we also look at what accounting policies. We have a lot of policies in the standard. We have several. Now the question is, which one have the organizations choosing to use to prepare their financial statement? Because accounting policy, we have them wide. We have what we call the cash basis, the accrual basis. So out of these two, which one do you decide? Which one have you decided to use? We also have different type of accounting policy. Okay, so ability to differentiate it. How do you treat your government expenditure? How do you treat your grants? How do you treat your assets? How do you treat your inventory? So these are examples of policy implemented. And there's actually standard also that IAS 8, IAS 8, which is accounting policy and changes in accounting estimates and errors. That is another standard that address the accounting policy. If there's changes in accounting policy or estimate or errors, that's another topic on its own. Okay. Now we now have what we call notes, or what we call summary to the financial statement. So note or summary. Note or summary is kind of about, okay, you have prepared the summary of your income, you have summarized your expenses, you have summarized your assets, your liability, and your equity. Now, the needed information that will now give more light to the summarized figure in an earlier statement. That's where that one to call notes to the account. Note to the account is like a backup to the statement of the information that you have included or added under under your statement of profit or loss account or statement of financial position. Okay. So that's that we have about that. Now, the other thing also have, okay, other report as well. We have other report also that is attached to it. Apart from the required one, we have other report that is attached to it. We have number one, before it was request that you put 5 years summary, which means your 5 years, your current year and 4 years in the previous year, add them together so that any investor or any outsider that pick up your financial statement can do some trend analysis to know if the company is growing or not, or if they need one or two information that they need to make economic decision on. So there's that 5 years summary. So, but it's not mandatory again like before. So it's optional now. There's another where we have other reports. We have other annual reports that is attached to our financial statement. So we have number one, we have the director reports. Number two, we have the auditor reports. Number three, we have the environmental reports. Number four, we can have debt reports. We can have performance reports, and so on and so forth. But those ones I've mentioned after this one, they are not what that I've mentioned, starting from the director's report downward, they are not part of statutory reports. It's not required by the standard, but it is added to enhance the quality of the statement, So that's the major purpose. So there's an allowance for you to add others. Remember, I said IAS1 actually try to achieve a particular thing. Give me stating the minimum requirement of the information that should be in your financial statement. The minimum. You can go ahead and add more, but the minimum requirement information that should be stated in your financial statement. Okay, so we have that an entity may use title for the statement other than those stated above. All financial statements are required to be presented with equal prominence. Okay, we have that. Now, exceptional items. We have exceptional items. Exceptional items are basically the items that are material in nature. they are material in nature. That's the exceptional items. So they are what given what material in nature. It means that the sizes, their sizes, the income or the expense or the nature or the incident that disclosure is necessary in order to explain the performance of the entity. So we are talking about the materiality concept now. This one is talking about that if you omit a particular figure or you wrongly state a particular figure, it can change the performance of the entity, or it can influence or change the decision that that person has made when the information was not stated. So if I make if I have a debt of 1 million and I didn't include it in my financial statement, I have a debt of 1 million. And once I include that in my financial statement, I have a debt of 1 million. It shows that my company is actually not performing well at all. So it means that that debt is actually what is material. It is expected to be included on your financial statement. That's what it means. That's what material items mean. The size or the nature. So it's not about just the amount again, also it's the nature of it as well. Probably you have it closed down. You have like 3 branches, and towards the end of the year or after, just you close your financial statement 31st December, then January, middle of January, you have to close down 1 branch. It's expected for you to what? To come back and state it there under what? Under your note to the account that, oh, this so have happened. That is a material thing because it means that by next year, your revenue will be affected because the other branch that brought in some revenue we no longer function again. So it's actually what? Material. It's actually very material. So and that is why we have another standard that talks about report event after reporting date, event after reporting date, but that is not meant for you for your at your level at the moment. Now let's look at the accounting treatment is to, okay, I've explained this. The accounting treatment is to include the line in the standard notes of a financial statement or disclose the nature and the amount in notes. So it depends on how the standard how the standard directs you or guide you to address the issue. So if this some standard like it's one I said earlier, it will be under the notes, but there are some that is provision. Maybe you are facing a litigation issues, and when you have that litigation issues, you notice that, oh, it's possible that you'll be charged, and that charge you have is the amount that you will charge is on the high side. It's actually very reasonable for you to raise a provision for it. So you have a lot of reasons why what any item, once you know that the omission of it, or if you wrongly state it, it can affect the users of your financial statement, then it means that what you need to add that information to your financial statement. You need to add it to your financial statement. So example, okay, so we have the example of it. Can you see example? We have written down of investment on inventory. When your inventory, you are carrying that 20 million, but later on, you know that 20 million is not, no, it's not visible. It's not 5 million. Can you see that what has crashed? It has crashed your. So it means that next year, you will not be able to even realize that 20 million that you have put there. The only thing you can realize is 5 million. That's what we talk about net realizable value. I believe we have done that under inventory. Inventory IS, that's IS2, under the inventory, where you talk about the method or model for valuing inventory, cost model or what? Or net realizable value, the one that is what? That is lower. Okay, so we have another one we have also is written down of property PPE to recovered amount restructuring. Okay, gain or loss on asset disposal. These are the examples of exceptional item that you need to put. Discontinue operation, litigation settlement, reverse of provisions, and so on and so forth. Okay, please, you need to note that. Now, statement of financial position. So they give a brief breakdown of statement of financial position. So statement of financial position is actually an entity. It is an entity shall what? It says that an entity shall classify an asset as current on the statement of financial position. So you can classify what? You have to classify it as current, and you also have what as non-current. But what are the conditions that you must meet, that your asset must meet before you classify it as current? Number one is that it expects to realize the assets. Can you see? It expects to realize the assets or intend to sell or consume it in its normal operating cycle, in its normal operating cycle. Now, for example, now that was an example of those assets is receivables. Receivables. When you actually make sales on credit, you intend to what, to collect that credit sales or the fund from credit sales within that was normal operating cycle, which is within the year of purchase. That's normal operating cycle. So we are expecting to what, that this credit sales that I've made today, within the next 12 months, I'll recover back my fund. Or inventory. When you buy inventory and the reason why you purchase the inventory is to sell it, that can be classified as well as current asset. As current asset. So then that's okay. It's all the asset primarily for the purpose of trading. So the reason why you purchase the asset or the reason why you're holding the asset is for trading purpose, not for production purpose. Production purpose means that you are going to use it to produce another resources. But this one is what? It's for trading. It's for trading purpose. Then you can classify it as what? As current asset. Also, it says that it's expected to realize the asset within 12 months after the reporting period. After the reporting, it means that okay, if you're unable to realize the fund or to realize the asset within the normal operating cycle, at least within the next 12 months after you upload your financial year, you should realize that your asset. And also we have what? Cash and cash equivalent, unless restricted. Unless it's restricted that, oh, this amount that you have put into your deposit, you cannot access it for the next 5 years. That is the only reason why you are not going to classify it as current asset. But once you can access the money at any point in time, it means that you can easily convert it, you can easily consume it, you can easily change its form from within a short period of time. Then it can go ahead and be classified under under the current asset. Then I say, after they have given us the features of current asset, all other assets are classified as what? As non-current asset. So it means that once you have identified the current asset element, all other one will classify as what? As non-current asset. As non-current asset. Now, an entity shall classify a liability. So we are now on liability. Remember, I told you that statement of financial position comprises of 3 elements, which are assets, liability, and equity. Now, we have been able to identify what are the features, what are the criteria that an asset must meet before you classify it as a current asset. Number 1 is that what? That it must not be, the reason why you have the assets is to realize it within the normal operating cycle, or when you purchase consumption purpose, or if it's for trading purpose, or if it's expected to be realized within 12 months after the reporting period, and cash equivalent unrestricted. That is for current asset. Now, let's go to our current liability. Going to our current liability, you now notice that they have the same criteria with the current asset, but with a little trick to it, because an asset is actually positive to the organization, while our liability is negative to the organization. So they just tweak it a little so that it can fit into that position. Now, what are the criteria or what are the features that a liability must have before you can classify it as current liability? Number 1 is that it is expected to settle the liability in its normal operating cycle. Settle. We define liability as a present obligation as a result of past event, in which the settlement, can you see that? In which the settlement. So it means that there will be outflow. Once you want to address that liability, it will always lead to outflow from the entity that bears it. Okay. So now it means that if we settle a liability within its normal operating cycle, you can classify as current. If I incur a liability, my financial year my normal operating cycle is from January to December. Then I incur a liability as March, and that liability by August, I paid off that liability. That liability is current liability because it's still I still settle it within my normal operating cycle. Okay. Now that one also is if it owes liability primarily for the purpose of trading. The reason why you have that liability is primarily for for trading. That is the reason why you have that liability. What does that mean? It means that if your vendor supply you item on credit, he supply you the item based on Based on your trading activities. So if you have not, you are yet to pay your vendor. Now, for the fact that you are yet to pay your vendor, that is an example of current liability, because the reason why you have incurred that liability is as a result of your trading activities. Then we have the liability is due to be settled within 12 months after the reporting period. It means that when you close the financial year by 31st December, within the next, before the next 31st December, you will have settled that your liability. So if you owe anybody money right now, and you notice that at that money, within the next 6 months, I'm going to sort that money, then that is what? That is current liability. But we have some loan that take like 5 years or 2 years. Any loan that is 2 years is what? It's no longer current liability, is what is non-current liability. So okay, don't let me go into that so that it won't distort your knowledge. So that's also on, we have that. Then it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. It means that you don't have the constitutional right to postpone the settlement of what? Of the pay of that liability. You have to pay. It's an obligation on you to pay within that what? Within that short period of that short period. So that's what they're talking about it. That, and if you want to defy it, you have to what? You have to meet some conditions. Some penalties will be charged to it. They can ask you to pay additional 20% if you decide you want to defy it more than the next 12 months. They can ask you to pay 20% more, or they can even ban you from having access to it. For example, is overdraft. Overdraft, I said, okay, fine, this one, you expect to use this month for 2 months. After 2 months, you are not expected to work. After 2 months, you expect to return this money back to us. So if you fail to return it back to us, then charges or interest will now be what? Will now mature on the loan. So that was what? It means that once you defer it, once you fail to fulfill your obligation, then the interest element will now start counting. That is the condition. Okay. Now see every other liability that cannot be traced under current liability will be called what? The other non-current liability. Non-current liability are liability in which the settlement are more than 12 months after the reporting period. Non-current liability are liability that is due for settlement after what? After 12 months of the reporting, after 12 months of the reporting period. It means after the reporting period, 12 months after, you are still going to settle that debt. That is what we call non-current liability. Non-current liability. So we have that. Then, if a liability has become payable or demand because an entity has breached an undertaking under a long-term loan agreement on or before the reporting date, the liability is current, even if its lender has agreed after reporting date, but before the authorization of the financial statement for issued, not to demand payment or a consequence of the breach. So it means it's also, this is just a backup of what I've explained. Now, if the customer now agreed that, oh, we have default, so but we have actually agreed, and I'm not going to charge you, then it's still going to be what? It's going to be a current asset. It means if I'm expected to settle I'm expected to settle a particular debt, and I've classified the debt under the current asset, then at the end of the second year, I'm unable to settle that debt. Though we have actually discussed, and we have actually agreed and come to an agreed point that yes, I can go ahead and shift this payment for another 6 months. Then it will not be what? It will not be classified as non-current asset. It's still going to be classified as what? As current. Sorry, it's not going to classify as non-current liability. It's still going to be classified as current liability. So we have that. So that's it. However, the liability, so we're higher. However, the liability is classified as non-current asset, agrees by the reporting date to provide a period of grace ending at least 12 months after reporting period within the entity can rectify the breach, and during which the lender cannot demand for immediate payment. So now, if the institutional warrant them that, okay, this period now is going to give, you are asking for a longer time. Let's say you're asking for 12 months, additional 12 months. The additional 12 months have shown that you are asking for a loan that is more than your normal operating year cycle, and also is more than 12 months after your reporting year. So you can now go ahead and classify it as what? As non-current asset, as non-current asset. So that is that we have on that. So let's move on to the second statement. Now, the second statement says that statement of profit or loss and other compressive income. Now, other compressive income comprises of the income and expenses, okay? Income and expenses that are non-recognized in profit or loss are required or permitted by what? By other IFRS. Now, this is just talking about this other compressive income. It means the other income, the other expenses that is not required by the IFRS to be recognized before we arrive at our net profit. Before we arrive at our net profit, will be classified under other compressive income. Example, revaluation surplus. When you have revaluation surplus, it's classified under what? Other compressive income, because you are not expected to, and you are not expected to identify, or you are not expected to record your evaluation surplus under, you're not expected to record it or your evaluation surplus under your profit or loss account. What you expect to do is to recognize it under the other compressive income. Okay, we are going to get there. So another point also, another example, so a dividend paid out. When you want to pay your shareholders also, so you're not going to expect to, it's not expected to be found under your profit or loss account, also be found under what? Other compressive income. Okay. Now let's talk about total compressive income. Now, total compressive income is defined by IAS1 as a change in what? In an entity equity during a period resulting from transaction other than those with the owners in their capacity as owners. Okay, in their capacity or as owners. So basically, putting it so simple, total compressive income is the total of the entity profit or loss and other compressive income for the period. Picking it what? Total, very simple. It means your total compressive income is the addition of your profit for the year, which is for profit or loss account, and other compressive income for the period. Okay, I believe that's clear. No, before we arrive our, okay, when we start, we are going to start with statement of profit or loss account. Our statement of profit or loss account, we take our normal income and our normal expenditure in consideration. Then that is what we are going to use to get our net profit. Now, when we have our net profit, we now add other statement to it. We call it other compressive income. Now, when we join other compressive income to our statement of profit or loss account, that's what we call total compressive income. Total compressive income. And it's actually a way of measuring the changes in what? In the entity equity. Because what changes it apart from the contribution and apart from the payout, these are the factors that change equity. These are the factors that change equity. Net profit or net loss for the year, your revaluation surplus also, and what? And other information. Then we now have statement of equity or changes in equity. So we have statement of changes in equity. These are what? These are the summary. Is the statement of changes in equity provides a summary of all changes in equity arising from transaction with owners in their capacity as owners. This include the effect of share issues and dividends. So we're talking about the changes in the equity arising from the transaction, the changes, the beginning of the year, the end of the year, what happened in between, that give what can now make you arrive at the particular figure at the end of the year. So IAS1 actually require that all changes in equity arising from transaction with owners in their capacity as owners to be presented separately from non-owner change in equity. So it means that once you want to prepare this statement, you have to prepare it, and everybody, all of them will stand on their own. They will stand on their own. So horizontally, you are going to state it out. Horizontally, you have capital, you have issued of shares, you have dividends, you have retained earnings, you have evaluation surplus on horizontal basis. Then vertically, you now see opening balance. After opening balance, you see addition, you see disclosure, you see orders, you study there to now get at a what? Now get at your closing balance. So that's where you do it all down, all down. Now, there are some general features of financial statement that we have. We have the going concern. The going concern is actually talking about that the management have assessed that there's no material uncertainty as the ability of the entity to continue for unforeseeable future. This simply means that like if you are preparing your financial statement, everything be equal, you prepare your financial statement as if that the company will still be in existence for the next unforeseeable future. That okay, looking at this, we don't have a particular point that this business will cease to work or will cease to exist as a company. So we prepare that what is a going concern, is a continuous thing, a continuous thing. That mean of going concern. Prepare what like the management have no intention of liquidating or folding up the business, and there is no material certainty that will affect the ability of the business to continue the operation for the unforeseeable future. That is going concern. Then another basis that we have is what the accrual basis. Now, accrual basis is actually one of the bases that's adopted in financial accounting that talks about that your financial transaction or events are recorded on your financial statement when revenue are earned and when expenditure are incurred. So it's only when these two things happen that is where you can record the transaction on your financial statement. So it means that under accrual basis, they don't wait. They don't wait for movement of cash before the transaction is recorded. Then we have the consistency of the presentation. Now, consistency of presentation is talking about that the presentation and classification of items in the financial statement should retain from one period to the next, unless it is clear that a change will result in more appropriate presentation or is required by the standard. It means that you have to be consistent in what you are doing. It's not that you do A tomorrow today, you do B tomorrow. No, you have to be consistent. And the reason is that so that people that have used your financial statement last year can see your financial statement this year by still believing that it's a trend, it's a going concern thing. So your presentation should be clear. The classification should be clear. You classify one thing as expenses today. Next year, you classify it as an asset. Upper year, you are classifying it as a liability. No, your classification, your presentation should try as much as possible to be consistent with the last or previous year information. Materiality and education are the materiality. Now, materiality is talking about an item is material if its omission or its misstatement could influence the economic decision of users taken on the basis of the financial statement. So I've explained this also. So sometimes also materiality standing alone might not make sense, but the aggregates of it might actually give the true nature of the business. For example, financial statements should therefore show materiality items separately, but immaterial items may be aggregated with amount of similar nature. Now, if you look at it now, you have a 1,000 year, you have another figure here, maybe rounding up figure, you round up this one figure, you round up that one figure, and all of them are expense. So if they are expense, we add everything together. We had all the figures, all these little figures that seems not to be material. You add everything together. You now notice if it's material enough, because after you have added everything together, it will now come out. Then, this thing is immaterial on the what when they are single, but now they are aggregated together is actually what material. It means that effect the financial statement should be corrected to implement that material item that you have identified. So Offsetting. Offsetting means that asset and liability or income and expenses should not be offset except when required or permitted by a standard or interpretation. Now, offsetting is just that, okay, I have an income and expense. Okay, I went to market. Okay, or well, for example, expense offset is I went to the market, I purchased an item. That item that I purchased is 20,000, and I sold the item for 50,000. So if you want me to just show my 50,000 as a revenue and my 20,000 as an expense, I'll just net it off. And I say 50,000 minus 20,000, that will be 30,000. I'll now go ahead and record that 30,000 as my revenue. That is what we call offsetting. You have offset, you have net off your cost from your sales to not get your net sales. It's not so in financial statement. You must show them separately, unless it is required by the standard. Unless required by the standard. Then comparative. Okay, we have this also comparative. Right? You must be what? You must be able to compare. Comparative. You must be able to compare information together. Last year, previous year, next year, ability to compare them together. We give or we enhance the quality data in your financial statement. And compliance as well. You must be compliance with IFRS, compliance IFRS. So that's what we have there. Then we have reporting. We have the reporting period. Now, reporting period is talking about the period in which we prepare for the financial statement. So we have the reporting period, which is the annual year that we have assumed as an organization to prepare the financial statement. Then we have it's always 1 year, 12 months, apart from the first time of preparing financial statement, and also if the business is liquidating. So the start point and the end point of the business is when that's the period when you fail to prepare your financial statement with you under 12 months. Apart from that, every other year is expected to be 12 months, which is a financial financial year or reporting period. Now, dividend is actually the addition to the distribution information in the statement of changes in equity. Now, dividend is talking about that the payout from the business to the owners of the business. That's what dividend about. Is the amount dividend proposed or declared before the financial statements were authorized for issue, but which are not recognized as a distribution to owners during the period and the related amount per share. So the amount of any cumulative preference shares not recognized. So now this is talking about that, okay, looking at it now, what are the dividends? Because the owners of the business also, they are into business to earn a living. So at the end of the day, what are you giving them in return? So what are you giving them in the return? So if the business actually would have done well, then they will take what they will declare. Okay, because of this one, you have a profit of 1 million, 40% of it, they will propose it. They will propose it that 40% should be paid to the owners, the shareholders. That's exactly to show that the resources committed to the managers have been well utilized, and this is the return from such utilization. So that is the summary about. Now let's quickly look at the format of a financial statement. Now, format of financial statement can be two. We have the T format and we have the vertical format. The T format and the vertical format. So this is the T format. The T format is just from the word T. So you just write a big T. So, and the line, the vertical line actually separates the T into two, which is what the debit side or the credit side. The left-hand side and the right-hand side, debit side and the credit side. Now, if you look at it here, we have information on the credit side. We have information on the credit side. We have information on the debit side. And information on the debit side is more like an expense. More like an expense and more like cost. That way we have on the debit side. But on the credit side, they are what? They are gain and what? Gain and income. Gain and income. But on the debit side, we have cost and what? And expenses. So looking at it, we have opening stock, purchases, add carry, new word, add wages. This wages there is a direct wages. It's direct wages. So add the direct wages, then we less return outward. That will not give us what we call what? Next is what we call cost of goods available for sales. That should be cost of goods available for sales. Cost of goods available for sales. Okay. No, sorry. purchases plus carried inward, and purchases plus carried inward plus wages less return outward, we give you the what? We give you the total goods. Are you with me? It will give you the goods that you have purchased during the year. It will give you the goods that you have purchased during the year. Then over time, you now add it to your opening stock. If you add it to your opening stock, it will now give you the overall cost of goods available for sales. Overall cost of goods available for sales. Then after that, you now less closing stock from it. Once you less your closing stock from it, that will give you what we call cost of sales or cost of goods sold. Cost of sales or cost of goods sold. Now, on the other side, we have the revenue, and we have on the other side, we have revenue. Can you see we have revenue here? After revenue, we have less return inward. Now, this return inward is the one you have made sales earlier. That sales that I make earlier is part of your revenue initially. But this time around, you are what? You are not, they are not, your customer is now returning back what he or she have bought before. So you need to remove it from your sales to not get your net sales. That's why we say less return inward. Return inward. If you have actually let it go before, but now it's coming back to us. That's the meaning of return inward. Item return by the client back to the organization. So then we now have net revenue. We have net revenue. Then over there, we go down again. We go down again, and we have our expense. So to get, before we reach our how do we get our gross profit? We have to get our gross profit, because it's at this point that we are going to stop what we call trading account. Before, there was back in the years, there was what we call trading account. Trading account stop at the when we get our gross profit. So how do we get our gross profit? Our gross profit is net sales minus cost of sales. The net revenue minus cost of sales. Now, once you subtract it together, it will give you your gross profit. So it means that your gross profit is the balancing figure on your debit side. So then you close it up. When you close it up, you come back here and open a balance or gross profit balance brought down. So at this point, you are still continuing with your statement of profit or loss account. Now remember, in previous classes, I've explained or I've identified that there are times that what we call adjustment, that what we call end of the year or end of the month adjustment. And we talk about bad debts, we talk about provision, we talk about assets, depreciation, we talk about earned income or earned income and the others. So one of them is this depreciation. Can you see we have depreciation here? Now depreciation here is talking about the item that are during the month you might not have. Okay, we're talking about during the month you may not have recognized it, but at the end of the month you are now taking the value of the asset that have been consumed for that month. So you appreciate it and you will deposit there. So that we have depreciation. So you have your depreciation for all the assets that are depreciable. You have it there. We have a discount allowed and others. Then at the end of the day, you now less the closing. At the end of the day, you add up all your income. There are other incomes here. We add everything up together. Then you minus it from your expenses. Once you minus it from your expenses, that will give us net profit. That will give us net profit. But if your expenses is greater than your income, that is what we call net loss. So your balancing figure, if your balancing figure is on the credit side, it's net loss. But if your balancing figure is on the debit side, that's what we call net profit. That's what we call net profit. And that net profit is the interlink, is one that joins the statement of financial performance to statement of financial position. So it's one that is joining, because you are going to lift that net profit down to where? Down to the statement of financial position. And that will be under the equity. And you see there, plus net profit or what? Less net loss. So that is the link. So is that statement of profit or loss account is not a standalone statement. It's actually the end product of it is being brought down to a statement of financial position. Statement of financial position. So we have this 50 format as well. We have the two sides. We have the left-hand side and we have the right-hand side. This is a statement. Because we call it a statement and not account, we cannot call it debit side or credit side, okay? We can only call it left-hand side and right-hand side. Now, on the left-hand side, we have the owner's equity and we have the liabilities. That's where we have the equity and the liability sections. Because if you remember your accounting equation, I think I explained it also. The accounting equation that we say asset equals equity plus liability. Now, asset equals equity plus liability. So it means that equity and liability will be on one side, asset will be on the other side. Now, if you look at this one on the left hand side, we have equity and liability. We have what? We have owner's equity. We have owner's equity and we have liability section as well. So there are the two sections that we have, the owner's equity and the liability section. Now, the owner's equity and the liability, if we add them together, it will give us our assets. It will give us our asset. Now, we first of all start with equity. Adding up all the equity, we have the opening capital. We have, if there's additional capital, we add it to it. We had, always remember, your net profit will be added. Your net loss will be what? Subtracted. Then less joins. Joins are resources taken out from business for personal use, for personal consumption. Those are joins. So because it's for personal consumption, it is assumed that the company is that the owner is actually taking away resources for his own personal use. So we need to remove it from their own equity. Even though it means that they are taking back what they have introduced into the business earlier on. So we need to remove it from the equity. That's why we are lessening it on that equity. Then we now have our closing capital. So after that, we now look at our non-current liability and current liability. Non-current liability, we have explained that. Current liability, we have explained that. So we had everything up together to give us our total balance. Then we now move on the right-hand side. On the right-hand side, we have the asset. An asset is divided into two. We have the non-current asset and we have the current asset. So these are what we have here. So we have cost minus the accumulated depreciation. We give us our carrying amount. So that is what we call net book value. You give us our carrying amount or what we call the net book value. Okay. So now, after that being said, so the next one is I want to talk about now. Let's go down for our time. Now, preparation of what? Preparation of financial statement using an extended trial balance. Now, an extended trial balance is regarded as working paper, and is used by auditor, or as an accountant as well to test run things. Okay, looking at, okay, this is what we have at the closing of the year. Every adjustment that we are going to carry out, every month-end adjustment or year-end adjustment, we now adjust for it to give us our new trial balance. Remember, I said trial balance is actually what? That's where we prepare our financial statement. But I now said that there's two types. We have trial balance and we have adjusted trial balance. Now, how do we get our adjusted trial balance? I said adjusted trial balance is gotten from where? From our initial trial balance. So now this extended trial balance just summarize all this story. Now we are going to have initial trial balance. Once we have our initial trial balance, the second column that we're going to have there is what we call adjustment. We're going to have an adjustment column. Then after that, we're not going to have what we call adjusted trial balance. We're going to have adjusted trial balance. So it's actually what? It's a list of accounts. And we are trying to adjust the figure to show the true picture of the organization. So let's pick an example and let's do that. So we have an example. For example, the trial balance as at 31st December 2018, we have sales 428,000. So we have those information listed out. Can you see? We have information. So even though it's not written, we have the left-hand side and the right-hand side. The left-hand side is the debit item. The right-hand side is the credit item. The right-hand side is the credit item. So we have to do the two. Now that we have identified the two, so we move on. Further information. So we have further information. Now, this further information is the adjustment on what? On our the ledger given to us initially. So the first one, what do they call it? That is this information. This trial balance. Okay, this is the trial balance that they give to us at the 4th December 2018. Can you see? This is the initial trial balance. They gave us initial trial balance. Sorry about that. They gave us the initial trial balance. They now gave us further information. That further information is the adjustment on the what? On the initial trial balance to now get our adjusted trial balance. To now get our adjusted trial balance. So let's do that. So am I okay? Now let's look at, you are required to prepare extended trial balance as at 31st December. So if I want to prepare it, firstly, I'm going to list out all. So these are my solutions going to be like. Can you see? So I'm going to list out all the accounts that is given to me under initial trial balance. I'm going to list everything out. And if I list it, I will list them out up to this point. Can you see that? We'll leave the column, leave the other column there. I'm just trying to look at. So I've listed everything. Then after that, I'm going to put the one on the debit side. I'm going to list it on the debit side, and the one on the credit side, I'm going to put it on the credit side. That's the first thing to do. When you're asked to prepare a extended trial balance, you always start from what? From your. We are going to go. Firstly, you start from your, what do you call it? You start from your trial balance, initial trial balance. That's where you start from. Okay. Now we have the figure listed out, debits, and we have credits. Then we now want to do adjustments. So how do we do our adjustment? You go back to the question, and from there you start reading. This is where you need to be to pay attentive. You have to pay attentive very well. Now it says that for that information, 400 naira is owned. 400 naira is owned for eating and unlikely expenses. For eating and unlikely expenses, 400 naira is owned. Now, if 400 naira is owned, and additional information or further information means that you must post it twice. You must do the double entry. Okay, that's the meaning. For that, it means that you must do the double entry. Now, looking at it, we have likely before. Yes, we have. We have the eating and unlikely here. Can you see here? We have it here. We have the, can you see 5,000? Now, this 5,000 is one given to us your initial trial balance. So, and this 400 naira now is owned. So this 400 naira that is owned simply means that you go down here and you need to add it. So you need to add that 400 naira to that 5,000. That 5,000 actually shows the total amount paid, but that's not the total value that you have enjoyed for that period. There's a difference between what you paid and what you enjoyed for. Remember, we said that expenditure, when under the accrual basis, expenditure is recorded when they are incurred. So we have incurred this likely or eating also. So you have to recognize it. So you are still owing 400. So what you need to do is add 400 to the 5,000 and create a liability section and put 400 there. That's accrued accounts. It means that you are owing that amount. So how do we do that? Because it's a debit, it's an expense. So I'll go to my adjustment column. Can you see my adjustment column? I'll go to my my debit side. I'll trace out my okay. This is it likely. I have my likely here 400. So I put there 400. So I'm good to go because I have my hand 400 now. So I'm good to go. So I now go second. I've debited this one. I have to credit, double entry. I have to credit. So what will I credit? I'll go and credit my accruals. Can you see? I'll credit my accruals account. Can you see here? We have it here, accruals account. So I'll just go ahead and credit it as well. So what that means is that I've adjusted for that figure. I've increased my expenses by 400 and I've shown my liability of 400 as well. So I'll move on also to the next one. The next one also says that 700 has been prepaid for rent. Now, 700 has been prepaid for rent simply means that they have paid a rent that I have not yet enjoyed. I've paid rent in advance. So the part of what I've not enjoyed for is 700. And because of the matching concept, it's very wrong for me to recognize all the rents for the year which I pay for it. Because that rent is not just for that period alone. Part of it is for the next period. And they have given us the part of it that belongs to the next period. which is what? 700. So I'll go to my rent. What is my rent here? I'll go to my rent. My rent is 14,000. So did I enjoy 14,000? Yes. Okay, did I enjoy 40,000? No. Rather, please. Did I enjoy 40,000 for the reporting year? No, because I still have 700 not yet enjoyed. So that is an asset to me. It means that the enjoyment will still flow. I will realize the asset in the next 12 months after the reporting date. So that's an example of current asset. So we have what? We have two accounts now. So I will need to reduce my rent and increase my what? My asset, because whenever your asset increases, what do you do to it? You debit it. So, and if you want to reduce your expense normally have debit entry. Now you want to reduce it. So what if you want to reduce it, you just go to the credit side and put the amount there. So we have a credit side here. So we go to rent. We have currency. We have here credit side. We have a figure here 700. Then you go to the other account. That the prepaid, the prepayment account does not exist here. So you have to create it. So that's why under the new account, you create it and you put what? Prepayment 700. You put prepayment 700. Then as well, you go again, you try, okay, you go again, you look for another one. Another one that we have here is what? It is decided that a bad debt of 1,200 should be written off, and that the allowance for doubtful debt increase to what? To 4,500. Now, there are two things here. One is your bad debt should what? Usually 1,200 should be written off. So the question is, do we have bad debt here? Do we have bad debt in our initial trial balance? No, we don't have bad debt. So we need to create bad debt account. And bad debt account is an expense account. So we need to create that. Now, where is the second leg that we go to? The second leg is that why you have bad debt in the first place? It's as a result of our credit sales. That's why we have bad debt. Now, these credit sales that we are giving, which account hold that figure temporarily that we are expecting that the client should pay us? The account that hold that figure temporarily is the trade receivables. So trade receivables hold that figure temporarily. So now that figure, now we have not realized that that amount cannot be realized again. So it means that we need to take it away from where? From the trade receivables. So we need to reduce our trade receivables and put it on expenses, which means we need to use to reduce our gross profit or our sales. Our gross profit, it will be better. Our gross profit. So we do 1, 2. So we come down to 1, 2. We trade receivables first. We have trade receivables that exist. So how do we reduce that? We credit it. So we have that. Can you see we credit it with 1, 2. That's the value. Then bad debt account does not exist. So you come down here and create a bad debt account. So we have 1, 2. So we have the 1, 2. Yeah. So we have done the 1, 2. Then after that, now you now move to the next one. Now the next one is your allowance for doubtful debts or provision for doubtful debt. Now, that provision of doubtful debt is not the first time that we have recognized doubtful debt. Allowance for doubtful debt. So because it's not the first time, we will only recognize the difference between the two. The difference between the opening figure and the closing figure. Now, what do we have here? Do we have what do we have here? Do we have allowance? Yes, we have. Can you see? We have allowance for doubtful debt. That's 4,000. And then I told us that in the question, share information C, said that allowance for doubtful debt should be increased to 4,500. It should be increased to 4,500. Now, if it's increased to 4,500, it means the difference is what? The difference is 500. It means the difference is 500. Now, if the difference is 500, then we go up and increase. We go up and increase allowance for doubtful debts by 500. So we credit it. Then we now debit. So we create another new account, or we post under bad debt. So there are two ways for us to recognize or to treat our provision or allowance for doubtful debt. Is either you create a new item for it as an expense, or you add it to your bad debt. What you add or you create is the difference. Please always note that the difference between the opening balance and the closing balance of your allowance for doubtful debt is what we are going to recognize under your statement of finance, also the statement of profit or loss account. Now, we want to increase this, so we increase it by 500. So we are putting under the bad debts. We are not creating a new item for it. Then the allowance for doubtful debt that we have, we credit it. So once we credit it, it means that we are increasing it. We are increasing it. Then after that, what that we have, depreciation is to be provided for the year at 10% on cost. 10% on cost. So if it's on cost, it means that accumulated depreciation will be in existing. We exist. Once we are keeping our asset on cost, our accumulated depreciation must come to life. Okay, remember we did that under IAS16. I believe you can still remember that. Okay, so depreciation is to be provided at 10%. Now, looking at it, what are our assets? Our asset is, okay, you see, we have no current asset to be 146,000. Now, 10% of it will give us what? That will give us 14,600. That is the depreciation for the year. So if you want to do that, under your adjustment, you look for your accumulated depreciation. Please, do not charge it against your non-current asset. You expect to charge it against your accumulated depreciation. So it means that your accumulated depreciation will increase. So I'll go ahead and credit that. Then I don't have my depreciation. Yeah. So I need to create a new account called depreciation account. So I'll call that depreciation account. And the depreciation account is an expense account. So it's one that will hold my figure on the debit side. So I have that on the debit side. Can you see I have that on the debit side? Then the accumulated depreciation will be increased. So I have that on the credit side. Then after that, I move on. After that, I move on and I look at my inventory at the closing period. Now, if my inventory at the closing period will knock off each other, it will knock off each other because inventory can be found under inventory account, and number two, it can be found under cost of sales. So it can be found under asset and under profit or loss account. So under the asset is found under the inventory account, while under the profit or loss is found under the cost of sales. So under the inventory or under the asset, if it's under the asset, it means that it will be found on the debit side. Right? So it's going to be found on the debit side, because that's an assets position. It's going to be found on the debit side. Then on the cost of sales as well, it's going to be found on the credit side because it's one that is reducing the total quantity of goods available for sales. Because we say that something is available for sales, and other words available for sales, you still have balance. It means that you didn't actually you didn't sell all. So remove the one that you still have from you, remove it from your cost of goods for sales. We give you the actual cost of goods sold. Cost of goods sold. Now that we are done with the adjustment, the next thing now for us is to prepare our new trial balance, or what we call adjusted trial balance. Adjusted trial balance. So our sales does not have any adjustment. So far our sales does not have any adjustment. We just lift it from the credit side down to this side as well. So our purchase also does not have adjustment. The same thing as wage and salary. Rent have an adjustment. Now, rent is on the debit side. Rent is on the debit side. If you come to the credit side, you see what? You see that the figure is on the credit side. So because they are on different side, that means that negative figure we apply. So 14,000 minus 700 will give us 13,300. 30,300. Now let's look at Lightning. Lightning is 5,000. Now it's on the debit side. We have another 400 on the debit side. So they are both debit. So far that debit, it means that is an addition. So 5,000 plus 400, if we go 5,400, 5,400. Then you repeat the rest across the question. Then at the end of the day, your total figure here, that's 600 under your new trial balance should be 659,600 on the debit side, and it must be the same figure on the credit side. It must be the same figure on the credit side. Can you see that? It must be the same figure on the credit side. Very, very important. If the debit side and the credit side refuse to balance, once they refuse to balance, it means that there's an issue. That's when you now go ahead and raise trial or suspense account. That's when you go ahead and raise suspense account. Now, taxation on profit as well. There's what we call taxation on profit. How do I account for that? Taxation is actually what? Because a company is seized as a legal person in the presence of the law, so it's expected of the company to pay tax. It's expected of the company to pay tax. Now, how will the company pay tax? The company will pay tax and they calculate it based on the estimate of their what? Of their profits. Tax is calculated on estimate on the profit. So they do 30% on the profit generated probably before tax. They do 30% for probably before tax to get an estimate. Now, the estimate is different from actual. Are you getting me? The estimate is different from actual. The estimate is, let's say the estimate is 20,000 and the actual is 15,000. There's a difference there. And there are ways in which to calculate that. Okay. But before we get there, what I want to know is there are some items. There are some items that we actually find under where as regard to tax, we have some that we have under profit or loss account, and we have some figure that we have under statement of financial position, and both of them are what are related to tax. They are related to tax. Now, the tax that you are going to find under your profit or loss account is the estimated tax for the year. Is the estimated tax for the year. And that have a formula. It has its own formula. And the formula is based on the overestimated or underestimated tax of the previous year. It is based on that. Taxation in the statement of profit or loss account might actually relate to the profit or loss section or to other compressive income. So, and also it relates basically on the overestimate or underestimate of tax from the previous year, because it's an estimation. So then what? It might be different. Just one I said earlier on, let's say I estimated that my tax will be 30,000, but when I compute it, my actual was actually 15,000. So that 15,000 I've overcharged my current year, right? So my next year, I need to adjust that tax on my next year figure. That is the working. So so the formula is I'll get my tax for the current year. So first one, let's talk about overestimate. And if I've overestimated my tax in the previous year and I want to do tax for the current year, so what I will do is that I will identify my tax at the beginning of the year. No, sorry, I will identify my tax for that year. Once I identify my tax for that year, I'm going to remove the over estimated one from the previous year so that I can get my tax for the year. So, and understand, so that way we calculate it. So the overestimated figure for the previous year is used to reduce the current year tax. Then if it's underestimated, it means that there's a shortfall. So for the current year tax, before you get the charge for the year, it will be added to it. Okay, so that's the way we're going to calculate. That we calculate the tax that we're going to recognize in our statement of profit or loss account. Now, it's possible that that tax also you have not paid it. As a result, for the fact that you have not paid it, then it will bring you under liability. We're going to come under the liability under the taxation in the statement of financial position. So the statement of financial position is actually it takes our tax. It takes our tax that, oh, this is a tax payable. The tax that is payable to the government. The tax that is payable to the government. So it can be tax asset and it can be tax liability. It can be tax asset and it can be tax liability. Tax asset is when you pay more than what you expect to pay. Then the difference is now your tax asset, which you are going to enjoy next year. But tax liability is when you pay less than what you expect to pay. That's when we have tax liability. It means that you are still owing government a particular sum of amount. So how do we calculate that? The way we calculate that is we have tax payable at the beginning of the year. If it's tax payable at the beginning of the year, you have that figure. They will now have the charge for the year. Now, this tax charge for the year we'll be getting from our statement of profit or loss account. The figure that we recognize under our statement of profit or loss account is what we are going to use to recognize under the tax charge for the year. Now, if I have a figure at the beginning of the year and I've added a figure to it at what during the year. It means that at the end of the year, I'm expected to have a lump sum of the addition of the two. But if I have lesser, let's say, okay, at the beginning of the year, I'm owing 20,000. During the year, the charge for the year is 10,000. It means that I'm expected to have 30,000 payable at the end of the year. But if I now have 5,000 payable at the end of the year, remember the total amount payable for me for that current year, for everything added together, opening balance plus the current year is 30,000. But at the end of the year, my closing balance is telling me 5,000. So the difference there is 25,000. It means that the actual money that I've paid is what is 25,000. It's 25,000. Okay. Or you can also do it the other way around. Okay, this is the total money payable for me, 30,000. How much is the bank saying I've paid? The bank saying, I'll bring on my bank account. My bank account is that I've paid 25,000. So I'll just do 30,000 minus the amount that I've paid out of it, which is going to be 5,000. 5,000 will be what? The tax payable at the end of the year. At the end of the year. So let's look at the example here. Example here says that Farm Fresh Company has a financial year ending on 31st December. At 31st December, it had a liability for income tax of some 7,000. Can you see? It had a what? The liability income tax of some 7,000. The tax on profit for the year to 34 December year 5 was 201. So the tax charge for the year 31st December year 4. See, can you the previous year now? They give you information for previous year. Year was overestimated by 6,000. So year 4 was overestimated by 6,000. During the year to 31st December year 5, the company made payment of 150,000 in income tax. So they say calculate the tax that will be what that will be shown under our statement of financial position and the tax that will be shown under our statement of financial profit or loss account. So we want to calculate the amount of tax that we are going to recognize or display or show on our statement of financial position and also on our statement of profit or loss account. Now let's start with our statement of profit or loss account. We want to do our statement of profit or loss account. That will now give us what is the overestimated balance of the previous year. The overestimated balance of the previous year is 6,000. Now, what is the balance that we have estimated for this year? The total profit, the total tax on profit for this year will give us 201. If we have the total price for this year for the 201, and we have the last year to be estimated by 6,000, so 201 minus 6,000 will give us the current tax that is payable for that year. For that year, give us the charge for the year. Okay, so now we have identified the amounts. We have identified the amounts that will be in our statement of financial profit or loss account. Now, for us to now do the one for the other one, okay, let's see it here. Can you see here? So can you see previous year 6,000, then the current year 205, minus it together give us 119. And this 119 is the charge for the year. Now, for me to identify the amount that I'm going to recognize my statement of profit in my statement of financial position, I will look at what is my opening balance. My opening balance is 77,000. Now, when I have 77,000, what is the charge for the year? The one I'm expected to pay for the year is 199,000. So 199,000 plus 77,000 will give us a total of 276,000. Now, this is the total money that I'm expected to pay for the year as it relates to what? As related to cash or to tax. So what I'm going to do is I'm going to remove the one I've paid. For that year 5, I've paid what? I paid 150. So if I've paid 150 out of 275, I will have what? I will have 126 left. So this, my 126, is a tax liability. That's tax payable as at the end of the year 5. That would be a liability on my part. Okay. Then the next one we have insurance or issues of equity and shares. Issue of equity and shares. They actually the enterprise. The enterprise gets funds from issues of shares. Many people will to subscribe to their shares to bring in more capital into the business for the expansion of the business and also to promote sales. So that these are the examples of or reasons why they will normally have of shares, sales of shares. So when an entity issues new shares, the issued shares become a part of their equity. The entity receives cash from the issue or possibly asset from other than cash. So it's possible that okay, I'm coming on board on your organization that is existing before. So for me to be a part or owner of your organization, I have to buy your shares. So I can buy my share, I can buy the shares by paying cash or by giving an asset in return. And I said based on what the two party agreed on. This is what the two party agreed on. So we have that now. The share is we have two things. We have the nominal value and we have the share premium. We have the nominal value and we have the share premium. Now, the issue price of the new equity shares is usually higher than their face value or nominal value. And nominal value is the amount that you have registered your shares. Your shares is 1 naira, that's 1 naira. It's 2 naira, that's 2 naira. Now, if you want to sell it, your equity share, which is your issue share, is always your issue price is always higher. The issue price is always higher than what? Than the nominal price. Than the nominal price. So the difference between the issue price and the nominal price is what we calculate or what we credit to share premium. That's what we credit to what? To share premium. Now, if there's any charges based on our sales of what? Sales of shares, any transaction cost that we incur as a result of what selling, that cost is charged against our share premium. But in the absence of share premium, that cost will be charged against the retained earnings. It will be charged against the retained earnings. That's if there's absence of share premium. But if there's an existence of share premium, that amount will be charged against share premium. Then we have an example here. We have an example. Let's look at the example. A company issues 200,000 shares of 25 naira each at the price of 250 per shares. Now that 25 naira each is what? Is the nominal value. That 250 per shares is the issued price. Now, the issue costs are 3 million. Now, this issue cost, it means that the cost that we incur for us to issue the shares and to sell the shares, we incur 3 million direct cost. We incur 3 million on that. So, as they show how this share issue will be accounted. So, how are we going to account for this shares issue? Number one is that we need to multiply 25 naira, that's the nominal value, by 200. That will give us 50 million. That is under the share capital. So cash account will receive it, which is bank account will receive it. So we debit the account and we go ahead and credit the share capital account. Then after that, we now need to check our share premium. Do we have share premium? Okay, looking at it, the nominal value is 25 naira each, while the share premium, the issue price is 250. So there's a difference between the nominal value and the issue price. So the difference there will now be used to multiply the total shares issued to now get our share premium. So 250 minus 25 times 200,000 will give us the value for the share premium, and that will be 45 million. 45 million. Okay. Now, looking at this now, the issue cost now. So because we have share premium figure, we have figured on share premium. For us, how do we attend that is we now go ahead and reduce or charge our issue cost against our share premium. We charge our issue cost against our share premium. Then how do we charge that? What we do charge that is simply by saying debiting your share premium and crediting your cash. Your cash is one giving. Your cash is giving out the money and is being received by by your share premium. So you are using to reduce the excess, the gain that you have generated from issues of shares. So that is the summary of the IAS1. That is the summary of IAS1. And also you are required, apart from the summary that we have done, we are also expected to know how to prepare financial statement in your exam. Very germane and very important that you must know how to prepare financial statement in the examination. Now, how do you prepare financial statement? Just apply Just apply everything that I've given you earlier. Just apply everything that I've given you earlier, apply into it, and you are good to go. For example, I'll just paraphrase this and we call it a day. Okay. Now, for example, say the following trial balance was extracted from the books of Ayomi at the close of business on 31st July 2018. On 31st July 2018. So that is so they give us trial balance and they now give us additional information. So what you need to do, there are two methods. Is either you what? Either you start with additional information or first you open your account. So you can in the exam, you just pick a page, write statement of financial. What are you expected to prepare? You're expected to prepare profit or loss account. So with a page, you just write profit or loss account straight up. Then you move on to the other side, which is what on that page, you write statement of financial position. Then you will now move to a fresh page and do your workings there. Okay. And do your workings there. That's the second method. That's what we call you open your account down. You open your account down. Once you have opened them, the next thing for you is now what to do the appropriate thing. You must know the format. I'll show you the format earlier. It is a must for you to know the format, for you to know how to post. If you don't know the format, you will not be able to know where to post expenses and how to arrange expenses in relation as relates to what? To income. As it relates to income. Is it income that comes first or expense that comes first? So you use that, okay? So that let me give you as an assignment. Let me give you this as an assignment. So in the next class, we're going to talk about it. Okay, so let me give an assignment. So please practice it. You have your solution there already. You have the solution there with you already. So just practice it. Then you have like 3 questions there. Make sure you practice it and get back to me. So when I review your solution and I notice that there's a need for me to come in and explain 1 or 2 things, I will surely do that. Okay. So this will be an assignment. Thank you so much for the time. I appreciate your time. Using this period to wish you the best in your exam. And I believe that when you're leaving the exam more, you will leave with a bright smile on your face. So what I want to do is just go through this question, solve it. If you have any issue, either with question 1, question 2, or question 3, they are practice question. They are examination question. Solve it and get back to me. Okay. So I wish you the best of luck and thank you for trusting first choice accuracy for what first choice accuracy success link. Thank you so much for joining us. And we believe that we have been able to impact into you one way or the other. Okay. So we are actually located at my in between Mine 12, Glass House, Mine 12. So not far away from the work. We're actually on the road. So on the main road, not far away from K2 and also not far away from Mine 12. So that's our physical center. So you can come along also, tell your friends and bring some of your friends also along. Okay, so I wish you the best of luck in your exam, and I hope to see you in the next on the next stage. That's the next phase, which is skills level. So enjoy the rest of the day. I remain myself, Ujo Israel Watu Global. Bye for now.